understand. To some extent, I understand why, especially because we've been heavily dependent on foreign aid. I mean, over the past couple of years, we've received a lot of foreign aid. We still receive foreign aid. So a lot of people view Africa as a place for charity, come and do charity, and people are not too sure that their capital will work for them. But there's definitely a very huge investment opportunity in Africa. Over the past couple of years, we've seen heavy inflow of capital. This year alone, I think about 4 billion, according to Africa, 4 billion has been invested in private equity deals. And so I feel like it's because of Africa is extremely young in terms of development. We have a very young population. Median age is 21. We have a very large labor force. And so Africa is really the future. A lot of investors are seeing this. So they're actively now chasing Africa more for investments and less for charity. So I think the view of Africa being a charity case is getting old. And then people are starting to see the value that Africa will bring to their investments.
I hope so. I hope that comes to pass. And you're right, we're seeing the trend already going on, right? We're seeing more buzz and news, when it comes to investment cases, and we're seeing it become sensational in a good way, at least compared to charity. And, selfish interest, personal interest drives motion as well. Just wanted to see if Joshua, you wanted to share any thoughts on that as well.
Yeah, I mean, I do agree with Ginika's points. What I will add is coming from, because currently I work now in the humanitarian / impact space, and I would say, or I would argue that the humanitarian and impact fields have a more established, what you might call it now, more established frameworks for engagement in this part of the world. So what I mean, for example, is when the Bill and Melinda Gates Foundation gives a grant, or the UN, like the World Food Program where I work with, it gives a grant. There's a country office in, let's say the grant is to a company in Nigeria. There's a country office that works with them for implementation. The impact is very clearly measured. The framework for assessing the impact is completely established. So it's like, we want to invest in, say, people providing food to IDPs in Borno State. The metrics are clearly laid out. It's measurable, it's tangible in terms of implementation, and you can easily review the process because there's a lot of structure around, unfortunately, because like she said, Africa has been used to aid for so long. So there's a lot of structure around aid disbursement and impact monitoring and evaluation, all of that on the continent. On the flip side, however, with venture capital investments, it's a different ballgame because you are investing in an idea that's yet to be proven, in circumstances that you cannot predict one way or another. A lot of projections are pretty much magic, and the risk is mostly your responsibility to be as an investor, coupled with the fact that the socio-political and socio-economic climes in many of these African countries are anywhere from unpredictable to just downright hazardous, as it is the case in Nigeria, for example. So you're not only unable to predict a lot of things, you're also taking a huge risk. So that's one of the reasons. I mean, I'm not justifying why there's less investment. I think there should be more. Something I argue for all the time, but I think that's also one of the reasons why it's more practical for people to invest in like humanitarian efforts and impact activities or related activities over venture capital style for profit businesses. And this is just my take.
Okay, well, that's a good take of that. And with these two questions so far, I've been able to understand the direction of capital. I have a good understanding of that, and the competitors of capital, so charity cases versus business cases. That's a good framework. And again, our goal is to try and help prospective angel investors in this chat to understand better and be more comfortable. And just as luck will have it, we have one question from the audience, and the question goes like this: what are the risks involved as an angel investor? This is tricky and it's interesting because when you work in an investment firm, you have a whole team, you have processes, that help mitigate against mistakes and blind spots. But an angel investor, or probably a first-time angel investor, what would you say are some risks that some of these guys on this chart should be cautious about before starting?
I would say, especially as an individual trying to invest in a business, you really have to do your due diligence. A lot of people are trying to raise capital. A lot of people come up with all sorts of numbers, different KPI metrics. You really have to make sure that you verify in one way or another the information that's being given by the company. A major risk, especially in a country like Nigeria or Africa, is regulation, right? So a business could look extremely good and they're performing well, and a regulatory body will wake up one day and say, implement one policy, and the business is dead. So that's one of the risks that we face, especially in a climate like Africa or Nigeria. But to a large extent, once you do your due diligence, you know what the business is, really understanding the business model, understanding what the company's growth strategy is, making sure that the founders themselves understand what their business model is, how they plan to scale their business, understand their markets. And those are key things that you should look out for when trying to invest in a company.
Yeah, okay, I was waiting for intervention. It does have anyway, yeah, I think that in terms of risks, you're definitely going to lose a lot of money. Let's start from there. As an angel investor, like the first 3 angel investments I made, they were all, they all flaunt. I don't mean the companies, I just mean the investments. Right, and I also think that angel investors, there's a tendency for people to jump on the bandwagon, because there's FOMO, your friends are investing in this, so let me invest. Invest in what you know, right? Everybody has their interests and things that they're passionate about, things they're knowledgeable about. Invest in those things, because apart from the money you give to the companies, they have a better chance of success if you're able to support them in other ways. Partnerships, for example, introductions, business development help, some direction with growth. So invest in what you know so that you can be valuable to the company beyond just the money that you give. And if you invest in what you don't know, it's more hurtful to lose money in that way when you invest it, because your friends are investing. I know it's a given that sometimes there's people who are more knowledgeable about you in terms of investing and the decisions they've made and what's worked out and what hasn't. But at the same time, there's no better person to waste your money than yourself, right? And your interests will never really align with everybody else's. So have that at the back of your mind every time you make an investment decision.
Invest in what you know. I like that. And we'll get back to that, because it always seems like a one-way street, like a seller's market, where the VCs or the investors dictate the terms and the entrepreneurs are on the begging side. So we'll get to that with a follow-up question. I'll just put that in our pouch about what to look out for in an investor. And that may be an advice to potential angel investors here on how to be attractive to potential startups, because not all of them are going to say yes to you, not just because you have money. But an interesting point that Ginika also pointed out was policies. One of the risks that you should be on the lookout for when investing is, are there policy risks in this? Are there structural risks? And how can that affect or impact my investment thesis? With that, I pose a question back to you about many of these people are angel investors, prospective angel investors, way out in the diaspora, way outside of Africa, but they want to invest. Every day they read different things on the headlines about how, in general, I think everyone across the world, or maybe Africans particularly, always have a lot to say about their governments, lack of confidence in the government policies and the likes. So this makes them worried, knowing that government policies is one risk factor for an investment. So can we really go beyond that? Meaning, do you have faith in African startups growing, given the government system we have as of today? and what comforts should investors be looking at when investing in African startups, despite the current governments they see across the continent?
I could go first this time. So when it comes to governments, I'm a pessimist. So I'm not going to try to give you any hopes. I don't trust the government to do what's right, unfortunately, especially in Nigeria. So what I usually would say from an investment perspective is the kinds of business that are most attractive to me are businesses that are diversified in terms of geography, right? You have a business that's in Nigeria and it's also in Ghana and it's also in Tanzania. It might just be that the platform is accessible to these places, but the fact that you have some spread will give me much more comfort than invest in Nigeria. Really, I don't care what your line of business is. I'm not saying there's no potential for you to grow, for you to succeed, but it's just that you're up against. It's like you're almost fighting a battle that you cannot win. I don't know how to explain it, but I mean, there's practical examples of this. You could put every foot right, or you could take every step correctly, and still get shortchanged by one policy or another. I did mention to you last time we spoke that, but I was on the path. So I don't like do anything with the government. I'm not interested, even when I was we only used to entertain like private sector bid for private companies and all that. Now, I got an invitation to come and be on some committees, some session with the Nigerian Information, NITDA, and the Ministry of Technology, whatever the name is. Sorry, I'm not saying disrespectful, I just don't remember what. And then I honored the invitation because of who we came from. Otherwise, with meetings like this, I just say thank you for considering me, but I'm just not available. And so I honored the invitation and I go there, and there's a lot of respect to people. I see people I know, I see friends. I'm not gonna name drop, even though it's tempting to do so. And we deliberate for like 2 hours. And at the end of the deliberation, we get promises from the minister, who's represented by the general of the NITDA, and very strong powered representation from government. And you know what happens next? I think a few days later, they come on Twitter, there's a new bill that they're sponsoring, which is the exact opposite of everything that was discussed in that room. It's almost like they took the entire points from the meeting, drew a table and said, how is the best possible way we can achieve the reverse of everything we've discussed? So how do we take this country back to 1923 or whatever? And I was surprised. I mean, I wasn't surprised, but I was disappointed, not even in the government, in myself, for taking that meeting. So the point I'm trying to make here is, if you don't have spread across Africa, it's a daunting task, both as a startup, as an investor putting money in your business, right? And the other thing I was going to say is when it comes to startups, because you spoke about earlier about startups, what they look at for investors. I don't know if that's the question you already asked, so I'm jumping the gun, but pardon me, I'm going to respond regardless. I think startups look out for investors that add value apart from the money they give. I also think that startups look out for investors that allow them creative expression. Back in 2014, 2015, when we were challenging to raise money, people would offer you $15,000 for 30, 40%, and they will tell you, if you don't like it, you can go, and it was tough. So now I see people who raise $100,000 without even sending a pitch deck. I mean, 100,000 was small, who raise millions without sending a pitch deck. And so it's a lot better, and so I think it's important to have investors who are considered fair, because many people take advantage of startups and say, well, because you haven't raised any money, we're going to take advantage of you. There are global standards, there are global best practices. You go and raise money from Silicon Valley, at Silicon Valley valuations and standards, and then you come and invest in Nigerian companies at Ibadan valuations. No disrespect to my Ibadan folks, that's just a reference. So I think it's something that startups look out for. The value you add, how fair you are, and how much into consideration you take the ideas that these people present to you, of course. But yeah, that's my thoughts, my contribution in that.
Thank you very much, Josh, for that explanation. And I know from conversations we've had in the past, you definitely shared your opinions on the government. Ginika, I know you probably want to give your opinion on this, but can you just quickly use the next 1 minute to just give an opinion? Because I know we have some other questions that I want us to address before we run out of time.
Okay, so just really quickly, I definitely share Josh's sentiments. If we're waiting on government to make some form of difference in terms of economic development, we will wait forever. But with that, I still believe that there's hope. If I don't believe that investors should wait on the government or governments to kind of fix our infrastructural challenges. There are tons of startups, companies that are currently trying to fix these problems. I know that over 50% of capital that came into Africa went into essential services. So things along IT, financial services, healthcare, education, agri. So people are actively trying to solve these problems. And so I don't think that investors should be too worried about, I think they should be more focused on how they can assist companies in solving our infrastructural challenges.
Thank you very much, Ginika, and I completely and fully agree with you. I mean, we can't let the government setbacks hold us back. At the end of the day, the future of Africa lies both in the government, but I think majority of the development lies in the hands of the private sector. I mean, I see that is, I think the government just creates the enabling environment, but as far as the actual infrastructure that needs to be built to really get these things going, that falls on the private sector. That's what I believe. Now, some people might disagree with me, but that's what I believe, and that's what I keep going with. But to move on to a question from the audience, Nobus, and Easy, I think you also had a question as well, but we'll get to you as soon as possible. But from Nobus, his question is, along with the lines of risk, how do we track credit worthiness as an angel investor and make sure they don't run away with the funds or something? So pretty much, I mean, how do we ensure that the funds from the investors are secure and actually disbursed for or used in the right way by the startups?
So I would say it's
Josh, I don't know if you want to go. You go ahead.
I would say it still boils down to due diligence. So it's your responsibility as an investor to know the company that you're investing in. One key thing, though, I would say is to look out for, so in terms of uses of funds, some of the things that investors do to kind of mitigate the risk is tranche their investments. So as opposed to if a company is trying to raise maybe $1 million, as opposed to giving them the entire $1 million, so that you have some level of control, you could give them in bits, right? So they present invoices to you. Once an invoice is presented, then you deploy the capital. That way, you're sure that they're using your capital for what they said that they would use it for. But in terms of credit worthiness, another thing that you could look out for is how, especially in a climate like Nigeria, is look out for how the company mitigates FX risk. So if you're investing dollars, for example, and the company is earning revenues in Naira, that's a huge mismatch, and it brings about a huge problem. We've seen how our currency has been moving against the dollar over the past few months. So you lose value if you're giving dollars and the company is earning revenue and earning Naira revenue. So look for ways or advise ways that the companies can reduce their FX risk. It could be exporting to different countries. It could be getting CCIs, but there are different ways to mitigate these risks.
Thank you very much, Ginika, for that informed answer. Josh, do you want to just go ahead and add to what she said?
Yeah, I'll just say that it's important to, build a relationship of trust with founders whenever you can, because that's why it's always said you invest in people. I think that somehow character, always shines through, and when you invest in people, I'm not saying you will always be right, but you have a better chance investing in people and the right people than in the right numbers. That's one. The second thing about tranching is when you try to tranche investments, this is something I've seen firsthand. I've messed. As a VP, I've messed. I realized if you don't tranche investments in a way that takes the founders into consideration, you don't achieve any impact eventually. So I think tranching is important, but tranche the request or tranche the funding in a way that it is useful to the founders. So instead of saying we're going to give you this amount every quarter, try to figure out what they need the money for and how you can, manage the disbursements in such a way that it guarantees an efficient use of resources. But yeah, I'm not going to go much further into that. I think Ginika has addressed all the other concerns.
Awesome, thank you. And I think we have just time for one more question. Easy, do you want to come back with the question that you had? I know you had your hand raised at some point, so I want to make sure we don't miss you. Easy, are you still on the call?
Yeah, I am. Thanks for calling on me. And my question was just to kind of clarify, because like the term startup can mean anything from like an idea in its ideation stage, or you're further in funding and worth however many millions of dollars. But for these companies that were investing as angels, my question is how much, depending on what size they are in, how much like consult advice, because you guys mentioned like, hey, join a company that build relationships with these founders, or a company that you really believe in. And also some of us in the diaspora, there are investors, also have resources. If nothing else, we can add to the company besides just, like you guys mentioned, just money. But my question, I guess, is, because I'm thinking of it like a company here in the US, like a startup here in the US. If I invest in a startup, they really don't give 2 cents of what I actually think about, like how this business works. They just want the money. But you guys are saying that in this environment, you can get to know the owners and essentially, have a little bit more influence, or help them help your investment succeed. How close is that relationship? How much do we actually get to say, hey, actually I do this in the West, I have these contacts, would this help? Like, how involved are we in the process of actually how the business runs if we invest?
Yeah, I could go first if that's okay. I think you're as involved as the founders need you to be involved, because there's also the risk of you forcing your opinions or your help on founders. And so that's something you want to check. But founders definitely, I cannot speak for the West because of this, of the platform of I'll say that you should consider what the founders want. They will always, if you create an atmosphere of honest conversation, transparent, conversation, communication channels, founders will always tell you what they need. I still have a personal relationship with my earliest investors from 2015, 2016. And we talk about everything because the atmosphere is there, and it helps all of my investors, all investors that invest, helps to the degree that we need them to. I think that's all that matters. I also think it's important to leverage platforms like Squord, where they have existing relationships with like companies, startups, and they can, I wouldn't call it pre-vetting, but those relationships serve as some sort of vetting process. And investing through syndicates are good as well, because sometimes these syndicates come from a place of knowing startups, knowing what they need, and having the confidence of the founders, to work with them to achieve what kind of growth that they need.
All right, thank you. Isa, I hope that answered your question, by the way. Oh, Ginika, did you want to add to that? It looks like you want to add to that.
Yes, just really quickly. Josh explained it perfectly, but I was just going to say one key thing to always ask your investee is, what are you looking for in an investor? And a good number of times, at least from my experience, they always have, beyond financial resources, they always have requests in terms of who they believe a good strategic partner should be. So they want someone that helps them with maybe entering a new market, gaining X number of clients. They always let you know. So it's always best to kind of ask the founder, what are you looking for, to make sure that what you're willing to offer aligns with what they're looking for in an investor.
Awesome, thank you very much, Ginika. Actually, I just have one more question for both of you before we jump into another fun part, which is some chance to hear from startups chance to hear from some startups, 3 startups. But question for Ginika and Josh. I know we've talked about some of the obstacles, some of the things to look out for when investing in the African economy and African startups, and some of the setbacks that are currently faced. I mean, that are currently being faced by these entrepreneurs. But then again, I know we have a lot of folks from diaspora calling in to really understand and to really get to know more. So for those who are interested in investing in these African startups, what would you have to say for them? What's the one or two key things that you really have to say to them? It could be advice, could be just anything to look out for. What do you have to say to them?
I think we've touched on this in different ways, but one thing I would definitely say is to, especially if you're away and you're trying to invest in locally, to always partner with someone on ground. So for example, a Squord, you could invest through a fund, or just know someone that will be willing to help you do the necessary legwork, because it's not enough to have meetings and exchange documentation. It actually makes a ton of difference physically going into the office of physically meeting the person that you're supposed to deploy capital into, just meeting their clients, having discussions with the clients. There's a lot of work that needs to be done. So I would definitely advise to partner with someone on ground that's willing to do all the legwork for you. That will make it a lot easier and also help you verify a lot of what the company claims that they're offering.
Yeah, I'll just add that you should invest. As always, I think this advice is valuable wherever you invest in, whether it's Africa or otherwise. You should invest in, again, like I said in the beginning, invest in what you know, or at least you are able to find the expertise, for example, to advise on that area. I think it's easier that way to understand what you're getting into. And second bit of advice I would say I'll give is invest in people, not in numbers. I think it's also important to do that, because sometimes you invest in a founder and the founder veers off into, there's certain circumstances where they pivot and they go into something else and they succeed, right? So you're really backing the person and not the numbers, not the idea, so to speak. And I think that's an important consideration to make as well. So invest in people that you feel like you could trust, you feel like you respect, you appreciate, you value, their values and all of that. You have common interest, expectations, and all of that too.
That's a very, very good point. And just before I jump into the next thing, just to pick up what Josh said about investing in people, because at the end of the day, great companies are built by great individuals. But just something that I'll say on that is we had a conversation with Michael Oluwagbemi earlier in this year, right? And he spoke with us about Aboyeji. So for those who don't know who he is the founder of two unicorn companies. And a unicorn is pretty much a startup or a company that's valued at over $1 billion. And he told us about how they invested in E when he just came back from Canada, and the company was Flora or so. And that company failed. That company failed, and the next company failed again. But because they were investing the individual, he ended up founding Andela and Flutterwave that ended up returning over 1,000x of the initial investments. Now that's a very good example of investing in the person and not the startup exactly. So, I just wanted to just add to that because that just really resonated with me. But yeah, I think that's all we have for the panel discussion. Once again, thank you so much, Josh and Ginika, for jumping on. I know it was a lot to get you on